Now, there's a massive change going on in the stock market right now. The Qs are rebalancing, okay? And so, I'll be honest, it doesn't make any dang sense, okay? It doesn't make any sense. So check this out, okay? This is fascinating. So Apple's going to basically be weighted a little less, okay? So they're going to ding Apple a little bit. But look at Microsoft's ding, okay? Microsoft, we're talking about 3 percentage points. Doesn't make any sense. Like, Apple and Microsoft are around the same year-to-date returns. They're around the same market cap, roughly. Like, to hammer Microsoft that hard and not hammer Apple, in my opinion, just doesn't make any sense. But hey, I don't own Apple stock. I don't own Microsoft stock, so I shouldn't really care. It doesn't make sense. Like, whatever these two they should have got hit around the same, but I don't know, man. Maybe somebody's playing favorites out there, something like that. Meta's getting hit a little bit. Nvidia's getting hit big, which, it's performed so amazing. You kind of understand that. But yeah, and so a lot of stocks are obviously going to see kind of moves up. But basically, the Qs are trying to rebalance to kind of de-risk some of the big dog stocks. So Tesla, Meta, Nvidia, Amazon, Google, McDougal, Microsoft, and Apple are all getting hit because of this, essentially. Okay, so it is something to kind of keep in mind out there. We'll see, I don't know. Stocks have been holding up pretty dang good. That's what I'll say about that. Now, you might have seen this in the news recently, okay? Everybody's talking about AT&T stock. And the reason is AT&T just went, I believe AT&T stock is down in the past 29 years, if I recall. 29 flip and flapjacking years. Now, I want to pull you guys up something very important. So this is since basically I got in the market around the end of 2008 into 2009. And this is how Verizon stock and AT&T stock have performed since I got in the market back in the day, okay? And Verizon stock is down about 12% since then. AT&T stock's down about 55%. Now, if you take into account the dividends you received over that entire time, you should hopefully have a little bit of a positive return, but it's not going to be that impressive, especially considering what the market's done over that time and what countless great companies have done over this time, okay? Now, what saved me from AT&T and Verizon stock? Because those are two stocks that I've always been very well aware of since I got in the market in 08, 09. I've considered them many times, but what saved me from not buying those stocks to get caught into the biggest value traps of the last 15 years in the stock market for two very famous companies? I'll show you exactly what I looked at to keep me away from those, okay? This is it, the debt loads. The debt loads are what kept me away, okay? This is where balance sheet matters. Now, even back when I would look at these companies many years ago, they had ridiculous amounts of debt. And guess what? The problem just really got worse over the years, okay? And as of today, their debt load's sitting at over double what it was in 2010. They're sitting at $128 billion of debt. The market capitalization of AT&T is not even $128 billion, if I recall right now. So this just goes to show you, if a company has an extremely bad balance sheet, even if they're making that recurring money coming in, like those debt payments are going to eat them alive. And it really also goes back to creativity in a company, innovation, and it's harder to have a creative culture and innovative culture when you're very debt-ridden and when you kind of have a monopoly on your industry. And this is something Steve Jobs spoke about many times in the past, or at least one time in the past. I remember specifically Steve Jobs talked about companies that get kind of like monopoly market shares and how easy it is for those companies to get very complacent, not innovate, not really move the ball forward. And I look at a company like AT&T and what have they done over the past 15 years, just to be quite frank, right? They haven't done a whole heck of a lot. Like, I remember they had the original iPhone deal back in like 2007. They were kind of the exclusive company to be with Apple's iPhone. And then that might have been their big innovation. The only other thing they've done is they've done some deals where they bought out some companies and then sold some companies. But ultimately, this has not been really a growth company, because at the end of the day, their business model was just, we're a huge cell phone provider and landlines as well. And so if you need a cell phone or a landline, you're going to have to come through us. And they got very complacent. And so that's the risk with a company that gets a monopoly type market share like an AT&T or a Verizon. This is what happens to those, right? And Steve Jobs preached about that, I remember, many times in the past. And it just goes to show you what ends up happening to a company like that, right? Fascinating to see something like that, right? Now, there's a few important slides I want to show you guys here that I think everybody needs to understand these. Basically every single week inside the private group, we put out this investor report. It's pretty comprehensive. We put a ton of information in here that's very helpful to members of the private group, right? And let me just show you a few things, okay? The first thing is the AIA investor sentiment, right? And if we go ahead and take a peek at this, last week we hit a bullish high of 46.4% for investors bullish on the market for the next 6 months. This week we're at about 41%. So the markets went a little less bullish, which is kind of surprising considering inflation came in better than folks expected. I guess we're just switching cameras. What I believe happened here is I believe the market's gone up so much that I think some folks just kind of looked at it as like, I don't want to be as bullish kind of moving forward. So a lot of those folks moved over to the neutral side. A few people moved over to the bearish side. And that's kind of where we're sitting as far as AI investor sentiment. Now, the CNN Fear Greed Index is in a bad place right now. In a bad place meaning like it's kind of scary if you're along the market because we're in extreme greed right now, right? Market momentum's in extreme greed. Stock price strength is in extreme greed. Stock price breadth is in extreme greed. Put call options are in extreme greed, right? Market volatility, safe haven demand are both in neutral right now. So now do keep in mind this can stay in greed or extreme greed for a long period of time. And actually, for much of this year, these readings have been in greed and extreme greed. So if you think like, oh, just because this is in extreme greed or even in greed phase, you think like, oh, this means the market's going down. Doesn't mean that at all. It's been like this almost this entire dang year, okay? It's been like this for a while now at this point in time. Something so important, one of the most underrated, most important things you can possibly look at in the entire financial system just came through, okay? And there's a University of Michigan Consumer Sentiment, which they've been doing this survey for literally generations, okay? Now, Consumer Sentiment Survey came in at 72.6% in July. That's up from June's reading of 64.4%. That's up 12.7% on a month-over-month basis and up 41% year over year, right? So this basically means the consumer is in a whole lot better place than they were at this time last year, or at least their feelings are, right? We're talking about sentiment here. The consumer sentiment, Michigan consumer sentiment, hit the lowest level we've ever seen it hit in history. It hit that literally in 2022, around summertime 2022. And since then, we have started to slowly come back to life. Now, this is a big move up here. So this is something I look at that is very important because let's be honest, we run on a consumer economy. If the consumer is not in a good place, guess what? If they're not feeling very good, they're not going to go out there and spend. And guess what happened? Companies like Amazon, Shopify, everybody saw a huge dry up in orders, right? And we saw that play out in Q3, Q4, into Q1. Consumers starting to feel a little better. So guess whose numbers we should start seeing improved quite a bit? Companies like Shopify, companies like Amazon, companies like PayPal, companies like Tesla, and many others. You should actually see their earnings, their revenue stories, and their guidance getting more comfortable over the next several quarters since consumer sentiment's come back so much. It's a very important thing to watch. And that consumer sentiment led you to where these company earnings were at, right? And now it's going to lead you kind of out of that situation. So this is a very important factor. It's one of the most overlooked in the market, and it shouldn't be. I think it's one of the most important factors to understand kind of where company earnings are going, and especially because we're such a consumer-driven economy, right? And ultimately where the economy is going, okay? Very important.